It's interesting. You know, the S&P closes flat. I get it. And Lori has some thoughts on this, and I'm interested to hear. But what I took away from today was the move in the bond market was, again, extraordinary in a word. Yields open on the lows, spent the rest of the day rallying to basically the highs. I don't think that augurs particularly well. Now, I think it was last week we talked about Bill Ackman, at least in the short term, ringing the bell in terms of his bond call. He was getting short bonds, thinking yields were going higher. That top ticked it for about a week. But if 10-year yields start to meaningfully go through 4.25%, I think that's extraordinarily problematic for the market. So I didn't answer your question, but the bond market spoke volumes today, Mel.
Yeah, Lori?
I agree. I mean, that was one of the first things I checked when I was trying to put the puzzle together. And I go back to the CPI report. It was a good print. I didn't learn anything here that we didn't already know. And I think the benefit, right, of inflation moderating and the Fed going on pause should be to boost the growth trade. Bond yields spiking are not going to permit that. And I think that's a tired trade that's due for a breather anyway.
Yeah, Karen, what'd you make it today?
I didn't know what to make of it today, to be honest. So we saw that data. It was slightly cooler, which was nice, but not wildly, right? So I didn't understand that 400-plus point reaction. And I get that some things had bounced, right? So the Qs bounced. The Qs have had a really rough go in the last couple of weeks. So that sort of made sense to me. Why the yield started to move so much at the end of the day? I mean, we were at 394, and we closed at 410 on the 10-year. Yeah. That was sort of surprising to me. I'm short the IGV. That was up a little bit today, but it's had a rough go, which if you're short is good, but I am long things that are having a rough go. So I didn't know what to make of it. You can make an argument that this cooler is better, that the Fed is done, or recession, maybe, even though we seem to think now there will not be a recession. So I was confused by the whole day, to be honest.
We've had multiple different conversations in the last week about Treasury yields and why they could be moving higher for technical reasons, in addition to, so Treasury refunding schedule, Fitch, other dynamics, foreign central banks less buying, maybe inflation in Japan, Japanese central banks certainly buying less Treasuries. It's a combination of also you had a CPI number that, as we've all said, was pretty solid. If you look at the 12-month annualized, you're kind of at 3%, 3.2. But at some point you saw below the surface, there's a lot of stuff in that inflation number that doesn't get any better anytime soon. So owner's equivalent rent, dynamics and things that. So is the best of the headline CPI behind us for now? That's kind of what it felt like. And you bring it back to a market that's been kind of directionless. And I realized let's not pick on the market. It was rock and rolling for a long time. So we're talking about 10 days of some choppiness. But when Apple is still now clinging to that 100-day, in other words, we talked about Apple a few days ago, and yeah, it rallied and it took it off the headline, but it's still right there at a very key level. And then volatility in the underlying market. There's a couple different charts. I don't know if we have the one that just shows even over the last 5 days. We had 132 days in the calendar year of 22, which I've often said is like the best, trading market I've ever seen in my career. This year, there's only been 32 of those days where you've had these 1% moves. So that was 132 times last year. We had either a plus or a minus 1% move in the S&P. It was the fourth largest, sample set we've seen of that occurrence since, I think, 1950. This year, only 32. In the last 6 trading days, we've had 7 of these moves, up or down 1%. And today, as we've all said, you had that CPI number. And from the peak of the kind of, hey, this is a pretty good number, the jobless claims number looked like also the labor market's weakening a little bit. S&P fell 140 basis points, intraday today. And so there's more vol out there. Triple Qs, as we've all said, haven't really, re-inspired themselves. The broadening of the market, we all know, could be somewhat limited if especially, we're going to talk about Ford and some of the industrials that don't look so good.